You ever buy a call before earnings only to watch the stock beat expectation and still tank? Yeah, we've all been there. Let's talk about why earnings season might be the dumbest casino on the Wall Street. Good morning, everyone. Welcome back to the Sensa Edge, where we don't trade on vibes, we trade on verified edge. Today, we are diving into one of the most chaotic corners of the market, earnings season, aka the time when every disciplined trader suddenly start behaving like they are in Vegas. Here's the cool truth. Earnings moves are wildly unpredictable. A company beats estimates, the stock might tank. Misses badly, it might rally. Sometimes it just sits there and your options evaporates faster than a meme stock on a Monday morning. If you're trading earnings directionally without a real analysis, you are flipping a coin. Except this coin costs you $4.50 per contract and has a 30 cents bid-ask spread and burns your theta while you wait. Right now, you might say, I'll just sell a straddle or iron condor. I don't care which way it moves. Nice try, but here's the catch. Implied volatility is at its peak before earnings. Once earnings hit, IV collapses. That collapses tanks both sides of your trade, especially if the stock moves outside expectation. You're not edging, you're hoping, and hope is not a good strategy here. Let me bring my screen and then let's jump into this. Right. All right, here's Sensa Market. I picked up a SPY, and then I picked up expiration date for end of this particular week, April 25. So this could be a smarter trade because structured way to play this. Again, this is Jade Lizard. You are selling a put for 535. You are buying a call for 546, and you are selling a call at 541. Again, there is no risk on the upside and a defined zone of profitability. Again, you might have to like put a stop loss just to make sure that if anything goes less than 528, you might have to add a stop loss. But here's what it is, right? There's no risk on this upside and a defined zone of continued profitability on the upside. This isn't just a coin flip. This is a carefully built structure that lets you profit if the SPY stays in a range and gets you out before the volatility crush ruins the party. Sensa Market lets you visualize strategies like this in seconds, so you're not guessing, you are planning. All right, let me bring back myself here. Again, pros don't trade earnings based on the vibes or Discord tips. They look at the historical earning moves, current implied volatility, and then they're going to go and pick those particular trade, whether the options are underpricing or overpricing expected movement. Right? If a stock usually moves 3% and the options are selling at 6%, selling premium may work. If it explodes 10% routinely and the market expects only 4%, might be time to buy. But you need the data to back your trade, not just a feeling. So here's what you can do. Pick 3 to 5 companies reporting earnings this week. Check their last 8 earnings move, how they did. Compare to the current implied volatility. Ask yourself, is there a repeatable edge? If not, skip it. No trade is still a good trade. And that's a wrap for today's episode. If you found value in this, share it with your friend who still says YOLO for a weekly calls before every earnings. Subscribe, leave a review, and follow us on the platform. Thank you all.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.